right? Divided by 100 times par value, which is 32.50 payment. So with this, you now know that this bond will pay you 2028 will pay you 32.50, 2029 32.50 plus 1,000. Okay. Now this is essential because you can use this information to figure out what is the fair value of this bond. Okay. Or possibly you can use the market price, the price at which the bond is being sold, and figure out what is the interest rate reflected on that bond. So we're going to do all those type of calculations today. All right. Before we go there, those are the three features we talked about. There is more. Additional features of bonds.
Dr. G?
Yes.
Real quick, what's that directly after the 3 before the percent?
Here.
There in the information you give.
This
Like
one?
3, 1, something.
3 1/4.
3 1/4?
Yeah, sorry. Yeah. Yep. So additional features of bonds. So those are some add-ons that issuer of bonds might put in the bond contract. The ones that are common are the first three that I gave you, and then you will find some others. One of them, for example, could be something called the sinking fund. Collateral. You could have seniority. You could have a call feature. Actually, no, sorry. Let me put that in a different order. Conversion feature. You could have a call feature. And you can have restricted covenants. And let's just stop there. So let's go over those things at some reasonable speed. You should have seen those in Finance 33 already. So this part should be a review. But sinking fund essentially is a provision that aims at making the retirement of debt on the part of the issuer more a little bit softer for the issuer's finances. So let's think about this for a second. You have a company A that has issued 1,000 bonds. Okay, those bonds have a coupon rate of 5%. Okay, so those are the bonds issued by the firm, and those bonds mature, say, in 10 years from now, or whatever, sometime from now. So over time, how much will this firm have to pay for those bonds? Well, 5% of $1,000 is $50 each month, right? So periodically, this firm will have to make, every year, they will have to make a payment of $50 for each of those bonds outstanding. So the firm would experience a $50 payment times 1,000 bonds, which is 50,000. Now, it's a reasonable amount, but what about the end? When the bond matures, the firm will have to make a $50 payment plus par times 1,000. How much is that? It's a large amount, right? So which cash flow is gonna be a bigger burden for the firm? The first one or the one that happens at the end when the bond matures? But clearly the one at maturity, this is the one that can make the company go bankrupt. So a sinking fund is a way to make sure that the firm will have enough money to make this last payment. So how can you organize a system that makes sure that the firm has enough money at the end? But there are at least two different ways you can approach that. One way could be have the firm save X dollars each year according to a schedule, so that at the end there is many dollars in here that then can be used to pay the bond. So this money is saved, invested, and managed by a third party, and this third party is responsible to make sure that the issuing firm is compliant with this schedule. So that's one way to handle it. So the firm spends $50,000 in interest, but then it puts aside, I don't know, $1,000 every year for the next 30 years, whatever number. And that total amount is then gonna be used to offset this large payment at the end. Another way to organize the sinking fund is by having retirement of bonds according to a schedule. So for example, on this first year, there is 1,000 bonds outstanding, but maybe the provision says buy back 50 bonds every year. So the firm goes on the open market and buys 50 bonds every year. So after 2 years, there is gonna be 100 bonds less. Then after 2 years, after 4 years, 200 bonds less. So ultimately, they will soften the impact of this large payment by reducing the numbers of bonds outstanding at the very end of the life of the bond. So either way, the objective is met. The firm is kind of spreading out this expense over time. Now the problem is that if a sinking fund is organized this way, as long as there are enough people willing to sell the bond in the open market, it's gonna be fine. In fact, this approach will make it more likely that current bondholders have an opportunity to sell the bonds at any point in time. There is always somebody willing to buy them in the open market. But what if nobody is willing to sell them? This is a legal requirement on the part of the issuer. So the issuer will have to find a seller of bond. And typically, if the sinking fund is organized this way, the holder may be forced to surrender the bond. So how do they decide who's gonna have to surrender the bond? They only need 50 and there is 1,000 outstanding. Well, each bond has a serial number, and randomly they select the serial number, and if you're unlucky enough, you will be forced to sell the bond at some price that is predetermined. Okay, so this might give you a little bit of uncertainty whether you will be able to hold the bond until the maturity, because it might be subject to this provision. But typically, the sinking fund is there to protect investors from default when it matters the most, which is maturity.
How is that different from a call feature bond?
So this one, they don't buy back all the bonds, they only buy the ones that are selected, and it's a very small number relative to all the ones that are outstanding. The call feature, we're gonna talk about that in a second, and that is completely at the discretion of the issuer. And typically, when an issuer exercises the call feature, will result in a clear loss for the investor. So that's pretty much the difference. And for all investors, all the bonds are gonna be called. This one is only 3 or 4 in a year, if nobody's willing to sell them. Okay, does it make sense? All right, collateral. Collateral essentially is tying one specific asset to that particular bond. So if the firm is in financial distress and there is not enough money available to pay the bond, that particular asset is going to be liquidated, and the proceeds go only towards the payment of that particular bond. So think of this as some type of insurance against default. Now, many times, firms have different bonds outstanding, and some bonds may be given priority over repayment over others. And so the bonds that have highest priority over repayment are called senior bonds. And then the ones that have lower priority are called junior bonds. So senior bonds have less default risk than junior bonds. Okay? Conversion feature. The conversion feature is a provision that gives the investor the opportunity to exchange the bond for a predetermined number of shares of common stock. So the investor can exchange the bond for predetermined number of shares of stock. Okay, so if you buy a convertible bond, you can either make money from the coupons and par on the bond, or at any point in time, or after a specific point in time, you can choose to exchange the bond for, say, 100 shares of common stock. That's the predetermined number. It could be 25, it could be 7, I don't know what it is. Okay. That's pretty much the choice that the investor will have. So essentially, a convertible bond gives the investor two different ways to make money. One is by investing in the bond, or possibly, if the stock goes up in price over time, the investor can possibly make money from exchanging the bond for stock. Call feature. Call feature is a provision that gives the issuer the right to buy back the bond at the stated price, called the call price. And this happens before maturity. So the issuer has the right to buy back the bond at the call price before it reaches maturity. So this gives the issuer the freedom to choose how long the life of the bond is going to be. It can be as long as maturity, or the life of the bond can end after a specific date. And the end of the bond will occur at that specific price. So for instance, if you look at some of those bonds, if you look at their actual contracts, there is a bond that matures in 2040, but is callable in 2030 at $1,030. This is the way that call feature may look like. So if I invest in this bond, if the bond is not called, I can hold it until 2040. But starting on 2030, the issuer has the right to choose to end the life of this bond and give me $1,030 in exchange for the bond. Okay. Now, typically there is a calendar, and they will tell you when else it can be called. Maybe it can be called in 2030, 2031, and there might be different prices at which it can be called. So those are things that you have to look at very carefully. Why would an issuer choose to call a bond?
You don't have to do all the coupons of the future.
So-
Called early.
Think about, we're gonna see this in a second, but from what you remember from Finance 33, what is the relationship between bond prices and interest rates?
That's right, depends on premium discount.
So, this is the relationship between bond prices and interest rates. And let's suppose that this is now, this, this is the current rate. This is the current rate, and the bond should be selling at this price. And let's suppose that the core price is this much. So possibly if there is a shock in interest rates, so if interest rates were to drop from here to, say, here, what happens to the actual value of the bond? It's worth this much, the higher value. So if you are the issuer of the bond and you exercise your call, essentially you're buying an asset worth this much, this many dollars, so you only need to pay that little. So when is that the issuer is more likely to call a bond? Well, when interest rates
Pretty
drop
crazy.
over time. Okay. Yep.
Mm,
Now, is this a good thing for the investor?
No.
So, well, let's see. I bought the bond at this price. If interest rates had gone down, I actually collected this much money. So in this particular case, I realized a capital gain. But think about it. Why did this guy call the bond? Well, because
Because he could.
interest rates are so low that the price of the bond is actually this high. So if I wanted to replace this bond with one that was identical and not callable, how much would it cost me?
A lot more.
It would cost me this much. But I got this little from this bond being called. So ultimately, as an investor, this is a bad deal. Okay, when the bond is called, typically the investor is losing money. Does it make sense? All right. Restricted covenants. So those are just some general provisions that limit the freedom of management, because if you think about how a firm is structured, who's in charge of the company?
Say that again?
Board of
Who's in
directors.
charge of a firm?
Board of
The
directors.
CEOs?
The CEO, but the CEO responds to
The board of
the board of directors. How do you become a member of the board of directors?
Aren't
You
you
get the
elected?
shares, hold enough shares.
You're elected, but typically it's because you have shares in the firm, right? So if you are one of the board of directors, either you have a considerable investment in the firm, or the owners of the firm wants you there. And so who do you respond to ultimately? If you are a board of directors, a member in the board of directors, board of directors, to the owners, right?
Mhm.
So you're gonna take any actions that make stockholders happy. You don't care about bondholders. And so those restrictive covenants are provisions that make sure that the actions of management are not hurting bondholders. A stupid example of this could be, we are the stockholders of a firm. We know that we don't have a very bright future because we have that kind of information, it's inside information now, but the outsiders don't know. So either way, we are not gonna have a bright future. We issue a bond and we collect a bunch of money, then I declare a dividend equal to the size of the bond issue, and now we go bankrupt. So what happened?
Bondholders got.
So the company is not bankrupt, but us as stockholders, we collected the dividend.
Mhm.
The ones who are at a total loss are the bondholders, right? So this is an example of an action of the board of directors or a CEO that leads to a complete disaster for bond investors, but not so much for stockholders. And so something like that, of course, will be listed here. Now, clearly, this was a silly example, but the more likely one, the more likely scenario is where you have the firm. You have the firm that has, say, $1,000 coupon payment to an existing set of bondholders. And this firm can take this $1,000, add $1,000 of its own money, and so take this $2,000 and turn it into $5,000. So if you are the firm, you can take this $2,000 investment and turn it into $5,000. So it's with 250% return. Clearly, it's a good strategy to follow, but with those $4,000, that is going to be enough money to keep making coupon payments, right? So the bondholders are safe in this scenario. What if the firm could invest in something that could either make 10,000, so could turn these $2,000 in either 10,000 or 2,000. We don't know which one is which. It's one of the two. So if things go well, this firm has taken those $2,000, turned it into 10,000, but then out of the 10,000, 1,000 has to go back to the bondholders, right? So if things are going really, really well, what goes back to the bondholders is always going to be $1,000. But what if things go poorly, like in this other alternative? You start with 2,000, you're now making 2,000, so you're barely making this payment. So who's facing the risk? But who's facing the risk is both the bondholders and the stockholders, right?
Mm-hmm.
But who is there to gain from the benefits of that risk? The benefit of the risk only goes to the stockholders. So clearly there is an incentive on the part of the firm to take on risky investments because yes, we are willing to take on that risk. But if things go well, we are going to make a killing. But if things go poorly when they take this risk, both bondholders and stockholders feel the pain. And the bondholders don't get the benefit of when things go well. So typically what they write in the restrictive covenants is something to prevent that kind of incentive. Questions? So if you're a bondholder, if you are actually thinking about buying a bond, what features would you want?
Definitely the restrictive covenant part.
So you want those guys to be kept under control. So you want restrictive covenants. What else?
I would want the senior part of the seniority.
You want to have priority in terms of repayment over other bondholders. What else?
Collateral.
You want collateral. What else?
Sinking fund depending
On how it's structured.
Yeah.
Okay.
Conversion.
And conversion. This gives you two ways to make money,
Mhm.
right? What is that you definitely don't want? You don't want to have a code feature,
Yeah.
right? You want to be in charge of controlling your holding period in this bond investment. So how do investors reflect the fact that they like some of those features?
They're willing to pay a premium for it.
So any feature that is beneficial to investors will then, holding everything else constant, will give the bond a little bit of a higher price. So features that are beneficial to investors. Will lead to higher bond prices. Yeah, so essentially those bonds will tend to sell, again, holding everything else constant, will tend to sell at a slightly higher price. What can you tell me about the interest rate associated with those bonds? If prices are higher, the interest rate of those bonds will be slightly lower. So another way to say that is you have higher bond prices and lower interest rates. Okay, so those bonds will reward investors a little bit less. So for instance, if you look at CDs right now, CDs, think of it as a bond. Because some of them, they're structured pretty much the same as bonds in terms of schedule of payments, although there are some little differences. But if you look at CD yields or interest rates, it will tell you that perhaps a 3-year CD have interest rates that are as high as 5.35% per year. So if you actually look at the specific CDs that have 3 years maturity and you sort them by interest rate, you will see that the ones that are actually at 5.35, they will have some features that are not good for investors. So for instance, they will have no collateral. Well, they do have collateral, never mind. They will have typically a call feature. So the ones with the higher rate that are advertised, they are pretty much callable. So those are the callable ones. And then if you go down, the ones that are not callable, their interest rate maybe is 4.75%. So if I invest in this CD, pretty much I'm guaranteed to earn this much for 3 years. But if I invest in this CD, for 1 year I will get 5.35%. But then after that, this CD might be called, and then at this point, if it is callable, you need to know at when and what price. Okay, so those are the questions you need to ask. So when you see, if you actually want to invest in bonds or fixed income in general, those are all things you need to be aware of, because there can be a substantial difference in interest rates between identical assets that differ only by one characteristic, and the characteristic can be the call feature. Questions?
So we said the 4.75 would not be callable necessarily?
It's not callable, yeah,
No,
so it has a
because it's
lower
lower.
interest rate, and therefore this is selling at lower rate means higher price. So investors are willing to pay more to be guaranteed a lower return, but for possibly a longer term.
Gotcha.
So typically, the longer the term,
Mhm.
the bigger the gap between the callable assets and the non-callable ones. Yeah.
Thank you.
Questions? All right, cool. So those are the features of bonds. And let's suppose you want to buy one. What kind of bonds can we invest in? So who are the issuers of bonds?
Corporations and
So the biggest issuer is the Treasury. Then there is the corporations or corporate bonds. Then there are government bonds. So actually, let's call them government agency bonds. And then you have local government, or what are called municipal bonds. So, why are we focusing on those 4 groups? Well, Treasury bonds are issued by one entity, it's the U.S. Treasury, the different treasuries in different countries. And those tend to be the bonds with the highest liquidity. So if you want to buy a Treasury bond, most likely if you go on Treasury Direct, there might be a brand new issue that is likely to be issued by the Treasury shortly. Or if you can go in the secondary market and buy one, and you're very easy to find some available for trade. The perception is that Treasury securities tend to have the lowest default risk. That's what you find in a textbook. But be careful with that statement. If you're doing problems in a finance course, then yes, if you use the keyword treasury, assume that there is no default risk. But in real life, some treasury securities actually do have default risk. If you take the treasury securities issued by countries like Argentina, Greece, they were on the edge of defaulting. Argentinian bonds actually defaulted years ago. So this statement, the fact that treasury securities are free of default, has to be taken with some degree of concern. Like the Italian treasury securities now, treasury bonds, have been rated lower than they were rated before, meaning that the rating agencies perceive a margin for default of those treasuries. But again, for textbook related learning, when we talk about a security that has no risk whatsoever, typically we say, well, it's the T-bills, treasury bills, short-term treasury securities. Corporate bonds. There is a bunch of different types of bonds. Those are the ones that tend to have those type of features attached to them. Those corporate bonds come in a bunch of different flavors, and they have considerably different levels of risk. So when you're dealing with a corporate bond, the main thing you need to be concerned with is liquidity. If I want a 30-year GE bond right now, there might be not enough sellers. So those are the issues that you might face when you deal with corporate bonds, and it's completely different than treasuries. The risk level varies. You may have some bonds that are perfectly safe in terms of default risk, so at the highest rating. But you can have some that are possibly classed, rated as junk. Those are bonds that have missed payments, that are very unlikely to actually make, they're very unlikely to meet all their obligations as stipulated in the contract. And then of course there is a bunch that are in between those two extremes. Okay?
And the highest is like the AAA, right?
So the rating, there are different rating agencies. Typically, depending on the rating agency you're dealing with, they give those securities grade that consists of like 3 A's, A+, and something like that. So when you're looking at rating agencies, make sure you know which agency you're dealing with and the type of rating that they, and the scale that they're using. And what are the criteria that they use to assign those grades. Agency bonds, those are bonds issued by some private companies that have some very strong ties with the government. Those are particularly important if you want to invest in European assets. Many European firms used to be completely owned by the government. Like in Italy, we used to have one phone company, only one, and there was a government-owned phone company. No competition, it was a complete monopoly. Now, eventually, later on, that company was made public, and so people started buying shares of common stock, and so they did like a typical IPO type of thing. But those companies still maintain some political ties with the government. And so when those companies issued bonds, even though they were completely mismanaged, their bond rating was low because they looked at their financials. But they never defaulted. Even though they possibly, if you look at their financials, you would say, okay, this company is not gonna live another 3 years. Mm-hmm. But from the political process was such that nobody in power wanted to have those companies default. So even though the companies were complete junk, somehow the government always got to deal with them. Mm-hmm. And so if you were a bondholder, those type of bonds maybe were selling at a relatively low price, but their coupons were pretty high. So they were priced as if they were risky. But in reality, since there was always government intervention and disrupted the actual risk assessment of those firms, they never defaulted. So their actual risk, the real risk was lower than the risk that was perceived. And so if you bought them at a low price, but then eventually they arrived to maturity, they always met their payments and stuff like that. So there are companies like that here in the US that they do have ties with the government, and they're probably likely to be bailed out if something happens. Fannie Mae, Freddie Mac, all those companies that typically buy mortgages and consolidate them, they are considered as part of this group. Now keep in mind, we talk about treasuries as having the lowest default risk, but any of those are exposed to default risk. Possibly they can default. Municipal bonds, those are issued by typically local government entities. And that can include a city, it can include, SFA has outstanding bonds. They're not publicly traded, they're traded on at the private level. What is the big thing going on in town now? Have you read the signs? Vote for proposition, whatever.
No, that's right.
What is that?
But you have to vote on it, like it's coming up, I don't know.
So there's an election coming up
Mhm.
in what is it, November 5th, right?
Yeah.
And what is the voting about?
I think it's to do with teachers. There's one to do with teachers.
There is one that has to do with teachers. There is one more, but the one more I'm talking about is at the local level. And I'm bringing it up because probably ties to what we're talking about right now. So what is it?
Municipal bonds.
The city wants to issue a bond, actually several bonds. And what are the reasons to issue those bonds?
Raise money.
Yes. Specifically, why would they want the money?
To afford projects or debt,
So they do have a specific list of projects that they want to do. And
and they don't wanna raise taxes.
so eventually they will raise taxes because they will have to pay the bond back, right? So
Yes, but that's later down the road, that's for future.
it's actually immediately,
That's
like.
for the next year.
So I was talking to a colleague, and I think my taxes might go up by about 1,000 a year if the thing passes. So I'm thinking about maybe setting the house on fire and move out. So that's it. It's just camp there. Yeah, just live in a camper. But this is one of the examples of municipal bonds. Cities can issue those type of bonds, and some of those bonds are specifically tied to a specific project. They're called revenue bonds. And then there are some called general obligation. So for instance, I believe that the ones that Nacogdoches wants to do are general obligation bonds, meaning that we are issuing this bond, we are selling it to the public as those bonds being tied to specific projects. However, from the investor's perspective, if you are one of those who actually buys those bonds, if they're issued, the only way you're gonna get paid is if the city raises enough money to meet its obligations. So how can a city generate money?
Taxes.
Taxes, right? So if there is enough property tax, if there is enough sales tax collected, then those bonds are gonna be paid. What is that can have an impact on the likelihood that those bonds default? And this is different than any other type of bond, that's why I'm pointing this out. When you're doing valuation of those type of bonds, you have to think about a little bit differently.
Don't they usually hire contractors for projects?
So ignore that part for a second. So what is that can make the city not meet its obligations? So
Failure to pay taxes.
what is that can give a city a shock in collecting revenues from
Like a
taxes?
natural
People
disaster.
fleeing the city?
People moving out, right? So, or say, what is the main source of sales here in NAC? What do you think? If you have to take a wild guess.
Apartments.
So apartments, although some of them are exempt from taxes, they don't pay anything. the big apartments that built here, they have an exemption from property tax for 10 years. Good deal for the city. What else?
It can't be the restaurant.
What do you do every day, most likely?
Liquor
Drive.
probably is.
Liquor.
Liquor. No.
I was waiting for it, the moment of honesty.
Oh.
Gotcha.
Oh, no. Okay, well, I was just
Oh,
doing
you
this.
said it.
Oh.
So, okay,
Net drug.
sales tax, let's say you go out to eat, right?
Yeah.
So,
With wine.
if a bunch of restaurants start closing, what is likely to happen to revenue for a city like this?
It goes down.
It's gonna go down.
Mm.
What if a city has only one very large employer, and the large employer, like a factory, closes down? What do you think is gonna happen? More people are gonna move out. And what is gonna happen to sales taxes? What is gonna happen to property tax? It's gonna go down. There were some towns that were completely abandoned after one major employer closed down. So when I was working for General Electric, I lived in a town called Schenectady, which is a few miles away from Albany, the capital of New York State. The major employer there was GE. GE decided to got pissed off at the unions and basically decided to move its operations from Schenectady to Georgia, I think. I don't know how many jobs were lost in that process, but Schenectady's population went from, say, 100,000 to 20. And so there was a bunch of buildings that were abandoned, and now the city didn't have enough revenues to do anything, so the school districts started having problems and so forth. So this is what could possibly happen. If Schenectady had outstanding bonds, most likely what would have happened to those bonds?
They defaulted.
They would have probably defaulted, or their payments would have been cut to a fraction to what was owed. Okay, so be careful when you deal with those type of bonds. Their issues are not very large, so there is a problem with liquidity. They're low liquidity. They might have some type of default risk. And the factors that can impact the default risk of these bonds, as I said, are different than the general other categories of bonds. Now, one thing that can mitigate default risk is for those type of bonds, revenue bonds. Revenue bonds have payments that are tied to a specific project. So especially if you go to the Northeast and the East Coast, there is a lot of tollways. So there is a city or a county decides to make a bridge, and in order to make the bridge, they issue bonds, and then the revenue from the tolls is what is going to pay those bonds. I don't know if the tollways in Dallas are funded the same way, I'm not sure. But as long as people use this service, there is gonna be enough money to pay off the bond. So the lack of population or things like that is not gonna affect these type of bonds that much. One benefit of municipal bonds is that their payments are tax exempt. So if you invest on those type of bonds, instead of having to pay taxes on your collection of interest, those you don't have to. Okay. So because of that, typically those type of bonds, holding everything else the same, then you have a slightly lower interest rate, because net of taxes kind of balances out with the other ones. One thing to keep in mind that has to do with liquidity that maybe we don't realize is that, let's suppose I want to buy a bond, whether it's a corporate or a government or a municipal bond. I look online and I find a 4.3 coupon and has a price that I think is good, so they calculate the interest rate, the actual yield is 5.1%. So this is the interest rate I get if I invest in this bond. This is the coupon payment. The problem is that when I look at how many of those are available for sale, I get two numbers. The first number is how many of those bonds are available for sale right now. There is 100 of them. So if I want 3, again, I'm looking at about spending roughly about $1,000 each contract. If I want 3, I only have $3,000 to invest. There is 100 available. However, next to it, there is a minimum quantity available. The minimum quantity might be a large number. So if I want to buy those bonds, even though there is 100 available for sale, the smallest amount of bonds I have to buy is 15, which can be a very large value. So if you're a relatively small investor, if you're working with an IRA or a fund, an account that at first is not gonna have much money there, your ability to trade in bonds directly might be considerably limited because of that. Okay, you need a considerable amount of capital to do it. So this is the reality if you want to invest in bonds. You might not find enough people willing to sell you the one bond that you want to buy. Questions?
On the revenue bonds, does that one have the same default risk, or it has less default risk than the general obligation, right?
As a different, the default risk of those bonds is determined, is affected by different factors
Okay.
than that.
So it's
let's
different,
suppose
but
you
it's
build
the
a
same.
bridge
Okay.
and the city is growing, but nobody chooses to use the bridge,
Mhm.
then your revenue is gonna be low.
Okay.
And this bond can default, right?
Okay.
So the factors that affect those two types of bonds may be different.
Okay, but they both have a default risk,
That's
just
right.
different
All of them
types,
do.
just different ways.
Yeah, the theoretical level, the only ones that don't have default risk
Is treasury.
are treasuries. And even those have a degree of default risk, which varies by country and so forth.
Okay.
Questions? You good? All right. So now we know all the bonds that are being traded. We know what kind of bonds we might want to buy. We know the obstacles that we might face if we want to buy them. So what is the fair price of a bond? So now we'll go to bond valuation.
Yeah, asset value?
Bond valuation, yeah. We try to estimate their value. So start with the timeline of a bond. So this is what you're promised by contract. This is maturity date. This is 1 period before, 2 periods before, 3 periods before, and this is now. The bonds or different assets are linked to a specific level of interest rates. And let's call it R, okay, for now. So this is the general level of interest rates. And the question is, well, what is the fair price of this asset? How much should I pay for it? So let's try to answer that question. Well, we know that this bond is promising a certain number of coupons, it's promising this par value. I know that for every dollar invested, every year, I should earn this much. So how can you come up with the value of a bond? Well, just look at the cash flows. If you have a bunch of cash flows, you can compute the value by looking at the net present value. So to come up with a way to calculate the value of a bond is just do the sum at the present values of the bonds and cash flows. So mathematically, the way you calculate present value is future value divided by 1 plus the interest rate to the end. Apply that to the specific instance. So you have that the value of the bond is equal to, you take the next coupon, compute its present value. The coupon 2 periods from now, compute the present value. Keep going like that, all the way to the end. And so we took care of all the coupons. But at the end, you also get par, so add par to it. And compute the present value of it. You agree with that? So we took each coupon, discounted, and what is the name of that problem in finance where you have the same quantity, the same cash flow that repeats at regular time intervals
Annuity?
and is the same time? It's an annuity. So this is the same as an annuity. And this part right here is just an amount that occurs once at some point in time. So this is called what? A lump sum. So one way to model this with a financial calculator is to deal with an annuity and a lump sum at the same time. So if I want to know the value of this thing, this is what I'm concerned with, computing its present value. All I need to worry about is deal with an annuity, so a constant payment, and then the lump sum is an amount at the end. So the way you would enter the information here is N is going to be the number of coupon payments. This IY is going to be your periodic interest rate. PMT is going to be your periodic coupon, and this is going to be par. And we solve for present value. So this is the way you calculate the value of a bond.
Bless you.
Questions? So let's try one example. You're dealing with a 30-year, 3.5 coupon. Bond with $1,000 par. Okay, so if I don't give you par, of course, always assume it's 1,000. And the question is, if market rates are 5.7%, what is the value of this bond? Okay, so we need to figure out the value of this bond. So the first thing that we need to do, the number that you get here is 3.5. This is the way you would read information about bonds, is the coupon rate. So what are the payments you're gonna get from this bond? The coupon is gonna be your coupon rate times par. Coupon rate is 3.5% times 1,000. $35. So this thing is going to pay you $35 a year for 30 years. And then at the end, we'll also give you $1,000. So let's put this in the financial calculator. Can you see it already here? Yes? So we are dealing with 30 coupon payments. The market interest rate is 5.7. The payment is 35, and a par you get, a maturity, you get par. So what do you get?
687.20.
687 rounded.
Mm-hmm.
Do you agree? So what happens if interest rates go up?
It's gonna decrease.
So if you look here, if interest rates go up, you're dividing by larger number everywhere, and so you're now adding smaller quantities, so the price of the bond should go down. What is the difference in terms of impact of a change in interest rates to short-term bonds and to long-term bonds? Which one is gonna be affected the most and why?
Long-term bonds.
So short-term bonds only have few terms here, and then they get par, right? So if there is a shock in interest rates, few terms are going to be affected. If there is a shock in interest rates, which variable is going to be affected the most? The one that is raised to the first power or the one that is raised to the 30th? The one to the 30th. So if you're dealing with a long-term bond, when there is a change in interest rates, they're gonna have many more terms affected by that change. So long-term bonds tend to be more sensitive to changes in interest rates than short-term bonds. And the valuation process kind of tells you that, okay? So if you are concerned with the price of a bond and how their value is volatile in response to changes in interest rates, well, be concerned with the life of the bond. The longer the life of the bond, the more that bond is going to jump in price up and down every time interest rates are changed. There are some bonds that have a life of 30 years, but they issue also some that have a 100-year lifespan. So a 100-year bond will have 100 terms, the last one being raised to the 100th power. So a tiny change in interest rates will have a massive impact on the price of the particular bond. I think Disney is the one that issued a 100-year bond.
Great.
I think it was done, yeah.
When it comes out,
Sure.
our joy.
Questions? How much of you remember out of this stuff? Please say, everybody.
Yeah.
I remember a lot of this from class maybe because I
From
had.
Finance 3333. And yeah, that's pretty much where this comes from. All right. So, there are two things I want to show you, and I need to do them relatively fast. Let's consider 3 bonds. So this is the same stuff that we do in Finance 3333. One bond has 5 years to maturity, one has 15, and the other one is 30 years to maturity. So those bonds are all identical, characteristics except their term, and all of them have a coupon rate of 7%. Okay, so those are 3 bonds. They only differ in terms of their years to maturity. Everything else is identical. But what I want to figure out is what are their values or prices if market rates are 2%, 7%, and 15%. So I want to see what happens to the price of each of these bonds under 3 different settings of interest rates. Now, we know how to calculate it, because the moment I'm telling you that the coupon rate is 7%, I'm telling you that the coupon is $70, right? So this is the way we will calculate all those things. But I want you to put the answers in a table, because we're gonna then use that table to draw some graphs. So this table is gonna look like this. This is years to maturity, which is 5, 15, and 30. And those are gonna be your market interest rates. And at the intersection of those columns and rows, we're gonna put the price of the bonds, okay? So, let's suppose I want to calculate this. So, NIY, MTNFB, I'm concerned with the price of the bond. The life of the bond is 5, market interest rate is 2, the payment of the bond is
Did you just say 70?
$70 exactly. And then this thing pays 1,000 at the end. Yeah? So using this, calculate the price of this bond. tell me what you get. Come on, quick.
Okay, 1235.
1235, do you agree?
Okay, I thought it was being delusional.
Yep.
I got that too.
So now, keep the same bond, just change the interest rate from 2 to 7%. So change these to 7,
1,000.
and you should get 1,000. Then change 7 to 15, and what do you get?
732.
732, do you agree? Now change bond, so for the next bond, what changes is the number of periods, so you're dealing with a 15-year bond. And start again from 2%, question mark, 70, 1,000. And then change that interest rate from 2 to 7 and then to 15. What do you get?
1642.
1642,
Down.
1,000 and
532.
532, do you agree? Now do the same thing for the last bond, 30 years maturity and same interest rate. And tell me what you got.
2,120.
Then 1,000 and then
474.
474. Do you agree with that? So, it's okay if I raise this, the calculations? Yeah. So, I want to put this in a plot. I want to put those market interest rates on the x-axis, and I want to put the bond values on the y-axis. I'm plotting, this is on the x-axis, this is gonna be in the y. So those are gonna be your bond yields or interest rates, and this is gonna be the bond price. So for the first bond, the 5-year bond, when the market rate is 2%, this bond sells at 12.35. When interest rate is 7, this bond sells at 1,000. When interest rate is 15, this sells at 7.32. So for the 5-year bond, we drew that relationship between bond prices and interest rates we talked about, which is inverse. If interest rates increase, bond prices go down, and vice versa. Now let's repeat the same thing for the 30-year bond. Let's skip the 15. So I want to plot those as a function of interest rates. So you get to 2120, then to 1,000, and then 474. And this is the graph. Yep. So this is for the 30-year bond. So what are the notable things to keep in mind here?
Intersection.
So the first thing is that if interest rates go up, bond prices go down.
Yes.
If interest rates go down, bond prices go up. If interest rates go down, bonds that have longer term experience what? A larger price increase than short-term bonds. And the opposite, and the same is true, but reversed, for when there is an increase in interest rates, right? Now, the other thing to keep in mind is that both bonds intersect at this point. This point is when, if the market rate is equal to the coupon rate, then the price of the bond is equal to par. This is true for all bonds. Okay? Now, if you look on this side, so look at this part right here. If the market rate is above 7, or is greater than the coupon rate, then the price of the bond is gonna be less than par. Par is 1,000, right? And those type of bonds are called discount bonds. At the same time, if you're on this section, this part right here of the graph, so if the coupon rate, sorry, if the market rate is less than the coupon rate, then the price of the bond exceeds par. And we call those premium bonds. Questions? Remember those terms somewhat? So, why do we care about them? What do we need to know?
It helps us figure out the value of the bonds.
Well, there is something else that you need to, that we can get from this graph and see why it's important to know the difference between a premium bond and a discount bond. I need to do another graph. I don't want to go all the way there. I'm going to do it here, but it's going to be small. So maybe you have to step there. I don't know if you can see it.
The intrinsic value of the?
No, not yet. Come down. That's it. I know you're excited, me too. I'm about to go to lunch, so that's all I'm thinking about. So I'm gonna do another plot. And this plot is gonna have on the x-axis years to maturity. And on the y-axis, I'm gonna put the price of the bond. And I'm going to use this table to build a graph and see if we can get some insight out of the behavior of bonds. So in constructing this graph, I'm assuming that the market interest rate remains constant. So if you're dealing with years to maturity for the bonds we have here, this could be the same bond. Think of it as the same bond. When it's first issued, it has 30 years of life. Then you wait 15 years, and there is 15 left. You wait 10 more years, and there is 5 left. So think of these as snapshots over the life of this particular bond. And so I only have 2 points. I have the 5, 15, and 30. And let's pick the easiest of them. Let's suppose that this bond was issued when market rates were at 7%. So this bond would have been issued at $1,000. Okay? Now, market interest rates remain constant. And so what happens over 15 years later? The bond has 15 years of life left. Market interest rate is still 7%. By assumption, we're holding that constant. And the value of this bond is still 1,000. Wait 10 more years. Interest rates, by assumption, remain constant at 7, and the value of this bond is still 1,000. So if I were to plot those 2 points, the bond issued at $7% will have those 2 points, and essentially will follow this path in terms of price. This bond will have, this is a par bond, this bond will remain at par, assuming interest rates don't change. Okay? So the behavior of over time of that particular bond is to have a steady price. Again, we are, by assumption, we're holding interest rates constant. Now we're gonna do the same thing, but with this type of bond. This bond, when this bond is issued, the coupon is 7%, but for some reason, market interest rates are 15. So the price of this bond is $474. So we put it here. Wait 15 years, the market interest rates don't change, and the value of this bond is now at 532. Wait 10 more years, hold market interest rates still at 15%, the value of this bond is gonna be 742. So this bond is experiencing a slight appreciation in value over time. So what kind of bond is this? It's selling below par, so this is a discount bond. What is the tendency of discount bonds over time? Well, it's to appreciate. What about the last bond? This one right here. It sells at 21.20, then 16.42, then 12.35, and so the price path of this bond is like this. Over time, this is a premium bond, will tend to decrease in value, right? So let's think about why this is working this way. Let's start with the par bond because it's the one that makes more sense. So let's suppose I spend $1,000 to buy this bond. Under this environment, what is the fair return I get on $1,000?
$1,000,
7%.
7%, right? So 7% of 1,000 is
$70.
$70. So what is fair in this environment is that every year I get $70 out of this investment. What is that this bond is doing in terms of payments? Well, it's giving me $70 per year. So this thing is giving me what is fair that I receive in terms of interest payment. What about this bond right here? The same investment of $1,000 should give me 15%. Should give me $150. But what is that the bond gives me? By contract, the coupon is only $70. So it's $80 short. It's $80 short for how long? But if interest rates are held constant, this thing is gonna be $80 short for its life. So investors figure this out. They know that the end is gonna be worth 1,000, and they start kind of discounting by how much this thing is short, all the way backwards until today. And they price the bond today based on for how long they're going to be short. Okay? That's why that bond sells at a discount. For the premium bond, it's the exact opposite. This bond, a $1,000 investment, should give me an interest of 2%. So this should give me $20, but this bond is giving me $70. So this bond is giving me $50 too many. And so when the investors back calculate all of that on today's price, they come up with a price such that the current price plus the coupon over the course of a year corresponds to a 2% return. So those bonds will sell at a price that is higher than par. Got it? Super fast, but it should be mostly review. If you're confused about that, just come and ask me. I'll go about it. By the way, no class on Monday. I'm going to conference. I'll post that on Monday.
Start our hike. Huh? Yeah, I would need you.
You see the board?
That was helpful. Not